Welcome to a video that I like to call the deep dive video. Don't let the name mislead you. I do a number of videos every week. I do a daily video, I do a weekly video, I do an intermarket analysis video. The last video that I do for that week, I go through all of the daily charts, I look through everything that I talked about during the week, and I pull out the charts that I didn't talk about either at all, or maybe just mentioned one or two times. The reason for doing this is maybe we get some insight or more clarity as to the current market conditions, specifically for the S&P 500. This is being prepared for Monday, July 24th. The first chart that we look at is the VIX, which measures volatility of stocks, and then we take a 3-month average of the VIX, and then both of those together, we take a ratio. And what I focus on is the red line. That's a moving average, where we're declining overall. The VIX goes down typically as the market goes up, and it just shows that there's not a lot of fear in the market. I also have another chart of the VIX where I plot an RSI 9 period, and I'm looking for extreme positive or negative readings. We're just about at the middle right now. I haven't been using this chart because I typically will look for extreme positive or negative readings, and we're not showing that. We also look at the VIX and then another thing called the VIX of the VIX, which measures the volatility of the VIX. What I mainly focus on is the moving average down below. And since the latter part of 2022, we've been seeing this really decline. That's typically positive for the stock market. That means that fear is decreasing overall, and that's what typically happens when the market goes up. We also have another chart of the VIX, but it's invisible on this chart. And then I have a 50-period exponential moving average of the VIX. We typically use static numbers when we're looking at the VIX, 12 to 12.5 on the low side. And then when it's supposedly high, that's when we get up to about 20. Well, the VIX doesn't always stay in those ranges. From 2009 through 2011, the upside was at about 40 and the downside was 20. Then for a number of years, we shifted to 20 and about 14 or so on the downside. It even dropped below that. After the COVID plunge, we ticked back up where 20 to 30 is the normal range. What we're seeing now is this is really dropping off as there's not a lot of fear in the market, and we don't know yet if this is going to establish a new range. We just watch this chart to see what happens over lengthy periods of time. We also have the VIX to the move ratio. The MOVE index measures volatility in bonds, where the VIX measures volatility in stocks. We take a ratio of that. Both of these are going down. Even though they ticked up a little bit, they're still below a declining moving average, suggesting that fear is not very prevalent. We look at another thing called the SPXInvesting index, which is like the VIX, but the VIX measures at the money options, where the SPXInvesting index looks at out of the money options. And when this really starts to go up into this red area, the market is expecting some kind of a big move. We almost got up to that area, so I was showing this chart for a little while, but now we've dropped back down. Some people think, whoa, when we get up to this red area, that's going to be negative for the market, or that's going to be positive for the market. We see some of both. When we spiked up, in this first instance, the market kept going up. In this other instance, that marked a top. Other times that marked a bottom, so we don't really know. We have to look at other charts to get the proper context. And then down below, we also look at the VIX to kind of compare that. We also want to keep track of where are we from the all-time high. We're currently down 5.86%. Then I usually show this chart too because the 4,000 level is a spot where the S&P spent a lot of time. We chopped above and below. I haven't been showing this chart lately because we're quite a bit above 4,000 now. In fact, we're at the 4,500 level. Technical alerts, and there's not very many this week. These are put out by stockcharts.com. When they're blue, they're positive. When they're red, they're negative. We just had 2 that were triggered on Friday. They're automatically triggered. These happen when an index crosses above or below a certain level. It can also apply to sectors. It can also apply to different markets that we follow. And we read this from the bottom up. Right after the market opened, the NASDAQ got above 14,100. Then later in the day, the communications sector had a BPI cross below 50. That's negative. That means there's weakness that's coming in. Sometimes we can have a list that's longer than what I can show you. Other times we just might get 1 or 2 alerts. Then we take 5 indexes that we follow. The Dow, the NASDAQ 100, the S&P 500, which is what I focus on the most, the mid caps and the small caps. We go to stockcharts.com. They have this objective scale from 0 to 100 that rates how these charts look technically. The higher the score, the better looking the chart. Coming in again first this week is the NASDAQ 100 represented by the QQQs at 97.8. And you can see this is historically how this has changed. This has been positive now for quite some time. In second place is the S&P 500 at 87.9. In third place are the mid caps at 77.7. In fourth place, actually moved up a little bit, is the Dow at 68.4. And then in last place are the small caps. They've been under some pressure lately at 67.1. Some short-term charts that sometimes I show and sometimes I don't. The first one is a rainbow chart going from 10 periods all the way up to 50 periods with simple moving averages. We keep this bigger because we want to see what are all of the colors in the rainbow actually showing, and they're smoothing out, suggesting that on a shorter term basis we're in a pretty solid uptrend. Then we also look at the 20 period simple and exponential moving average. We're far away from that now, so I haven't been showing this chart. If we start the fall, we'll be seeing, is this going to provide some kind of support? The same thing is true with the moving average tree, where we have lots of different moving averages on here. We're above all of the averages that are plotted on this chart, so I haven't been showing it. Then I also take a 20 period simple moving average of the open, high, low, and close. Sometimes this can act as support when we're going up. Other times it can act as resistance when we're going down. We're far away, so I haven't been showing that chart. Fundamentals, just to keep up with where we're at based on earnings, we're pretty much flat as we're going through earnings season right now. When earnings are flat and price goes up, that makes the PE ratio go up. That also makes the yield go down. Those are the dividends that you receive for the S&P 500. Intermediate term charts, we have a thing called the Connors RSI. We use this very similar to a regular RSI, except this is a lot more jumpy. We look for extreme positive or negative readings. Typically, when we're at the dashed line and above, that's positive. Below the dashed line, that is more negative. We're just about in the middle now, so this really isn't telling us all that much. We also look at 50 period moving averages, both simple and exponential, and we're far away from those, so I haven't been showing this chart. Also the 100 period moving averages, simple and exponential. We're still far away, so why show that chart? Then we have an intermediate term rainbow going from 50 periods up to 100 periods. We're well above all of the moving averages, suggesting good solid momentum. Then one thing that seems to be working, at least for the last year or so, there's all different kinds of cycles out there. There's yearly cycles, there's so many days, there's 22.357 cycles, whatever you want to do. Over the last year, the 50-day cycle seems to be good. Now, there'll probably be some point when it's not useful anymore, but at least in the environment that we've been in, this has been kind of helpful. If you look back, sometimes this will mark a bottom, other times this will mark a top. Still other times, the market just kept going in whatever direction it came in as the cycle came and went. The last cycle that we had was on May 19th. The next cycle will be on August 1st. As we get closer to that date, I'll start showing this chart and we'll just see if anything's going to happen. We also look at standard deviation. Are we above or below what the median or average price is over the last 10 periods? We're just about on the moving average. We also look at the Pring bottom fisher. This is actually getting a little interesting, but it's also negative at the same time. We're not generating a buy signal right now. That happens when we cross above the black line. We are turning up. That could generate a buy signal, but at the same time, we're not at a real deep reading right now. That's kind of secondary overall, but we want to see this at a lower level and then start to turn up. That typically marks some kind of a bottom in the market. If we continue to roll over and go positive, we haven't really had a significant downturn, at least as of right now. And if this generates a buy signal, that would just confirm what we're seeing in some other charts that are looking more positive. We also have an anchored moving average going back to the all-time high, and we're far away from that now, so why show this chart? We want to keep an eye on how far away are we above or below the 200-day simple moving average, and we continue to be quite a ways above it. The mass index, this is not generating a signal right now. When this line comes up to the dashed line and the blue line, then we pay more attention to it. Otherwise, we don't use it. This is a chart that I refer to every day in the daily videos, but I haven't been showing it because we're far away from this red line. What I did is you look at the lows that we set in 2022, the June low and the October low. I drew a trend line between them. Then I took a parallel line going to the all-time high and drew that red line down. It looked like this might offer some kind of overhead resistance, and we bumped into this a few times, but then ultimately broke through it. We're still far away from this line, so I haven't been showing this chart. We also keep an eye on the Ichimoku cloud. When we're above it and declining, that can provide support. When we're below it and advancing, that can provide resistance. All this are just a set of moving averages that are shifted forward, and a lot of people like to use these as some kind of signals. Long-term charts. We have a long-term rainbow going from 50 periods to 250 periods. We're well above all the moving averages, and the moving averages are flowing up nicely, suggesting a longer-term positive trend. This is another chart that we might be getting ready to use again. The basic idea behind this chart is when the 2-year yield spikes and starts coming down, that means interest rates are going down. That gives good short to intermediate term support to the S&P 500. Well, lately, the 2-year yield and the S&P 500 have been going in the same direction, so this chart hasn't been helping us. At the end of last week, we saw a real shift where the 2-year yield is now going in the opposite direction as the S&P, so we'll have to see if this starts to drop. Will that give some support to the S&P? Then if the S&P drops, we'll see if the 2-year yield continues to go up and eventually hit some kind of a spike. Support and resistance levels. I haven't shown a lot of these because I keep saying we're in no man's land, and I'll show them here on this video. We have quadrant lines where we go from the COVID low to the all-time high, and we just break that into 4 different chunks. This had acted as resistance a number of times, and we broke through that. Well, now we're in between the 75% and the 100% level, so I haven't been showing this. Then we have a short-term fib chart going from the August high to the October low. We've broken above all of the levels in this Fibonacci chart, so it's not really helping us. A longer-term fib chart, we're above the 61.8% retracement level. The next level up would be a full retracement going back to the all-time high. Now, if we start to fall, these charts might come back into play, but we're right in the middle now, so it's really not helping us. And this is a longer-term chart of the same thing. This blue line and green line are actually 2 different Fibonacci levels that are right on top of each other, and we're in no man's land right now. The next area up would be the all-time high. If we start to drop, we would be looking at the 42.14 level. Some broad markets. We use the Vixen, which is like the VIX for the NASDAQ 100. It measures the volatility of the NASDAQ 100. I don't really use the bar chart here. I mostly look at the line chart, and we're showing that there's not a lot of fear. Even though the NASDAQ 100 had a little bit of difficulty last week, and this did turn up slightly, overall, fear is still very low. We also compare the S&P 100, the big stocks, with the S&P 500. We were getting out of line with each other earlier this spring, but now they're moving more in tandem with each other, so I haven't been showing this chart. We also keep an eye on the microcap index, the really small stocks. Earlier in the year, we came down and set a new 52-week low. We've been able to bounce up off of that, and we're far from this level now, so I haven't been showing the chart. We also keep an eye on the weekly chart of the NASDAQ 100 as represented by the QQQs. This is an anchored moving average going back to the all-time high, and we're well above it, so I haven't been showing the chart. We're also keeping an eye on the financial sector where we're seeing some improvement. This is a longer-term chart that goes back to the high set in 2007. It came up and acted as resistance back in 2020. We fell down below that during the COVID plunge. Well, then we were able to break through that, and now what was once resistance becomes support. And as the banking sector was going through lots of problems, which still there may be more in the future, we came down to this level, and this support level has been holding. Now, the financial sector has been seeing some recent strength lately, so we're well off of this support level for right now. Rate of change charts. I just show these because they're really long, 250 periods. We're declining a little bit, but overall we are showing upward movement. And this is that same chart going back to 1980, also showing that we're seeing some longer-term improvement in the market. Looking at bonds, we keep an eye on certain yield curves, and all of the ones that we follow are still inverted, suggesting that we may go into a recession. We watch these every day because when they go back to being normal, that can start some kind of a countdown to see if a recession is actually going to occur. Then this, I'll probably stop using this at some point. This came into play during the whole debt ceiling crisis. When the 1-month yield and the 3-month yield were getting all crazy in here, they've now gone back to being more normal, and so it's really not telling us anything that we don't already know, but I still watch it anyway. We also look at the U.S. 10-year Treasury yield, and we subtract the German 10-year yield, and that gives us this line up here. And there sometimes can be a real strong correlation between this line on the top and what the U.S. dollar index is doing on the bottom. But when you look at the correlation, sometimes it's really strong, but now it's dropping off, so it really hasn't been giving us any additional insight. Then we keep an eye on TIPS and compare them to further out bonds. TIPS are Treasury inflation-protected securities. When interest rates are going up, people like to get into TIPS because they buy it, it's shorter in duration, and then when it matures, you can roll it over into the next higher interest rate. When interest rates are done going up, and they might start coming down, then you want to lock in longer-term maturities to get a higher rate that lasts for a longer period of time. When this ratio is going down, that just means that inflation worries may be subsiding. When it's going back up, that means that there are inflation fears, and we're pretty much chopping sideways right now as the markets are trying to figure out what in the world's the Fed gonna do. Then the last chart is we take the 1-month yield and we subtract the 3-month yield, and we should get a negative response. And that's what we're getting right now. For a while it was going all crazy, and I think that had to do with the debt ceiling issue. Some possible positive scenarios. I don't show these in every video, so I want to include them here. We look at the S&P 500 stocks above their 50-period moving average. We use this like an oscillator to get an extreme positive or negative reading. When it's above 50 and advancing, that's positive. Below 50 and declining, that's negative. We're positive right now, but we're not getting an extreme reading. We look at that same thing for the mid caps, stocks above their 50-period moving average. We are more positive. Then we look at the small caps, which are also positive, but not giving an extreme reading. We look at the percent of stocks in the S&P that are above their 200-day simple moving average. We use this like an oscillator too, and it's not giving us an extreme positive or negative reading right now. It's above 50 and advancing, so we would lean positive. Then this chart, it changes an awful lot. It's a 19-day exponential moving average of the advanced decline ratio for the S&P. When we're above zero and advancing based on price, that's positive, as well as volume. We tend to use this like an oscillator. We're not getting an extreme reading, either positive or negative, but sometimes we can use price and volume to confirm each other, but since they're not extreme, we haven't been using this chart. Thank you. I hope you found this helpful. There are a lot of different videos that I do post. Please feel free to check them out. Have a great weekend, and I will talk to you in the next video.